Hello everyone and welcome to your Glassnode video report for the week on chain week 33. I'm your host Checkmate and we're recording this on the 17th of August 2021. So this week we've really continued to rally higher with Bitcoin market showing a great deal of strength actually. And what we really want to look at in this week's newsletter is a bit of a look under the hood of what's driving this rally, what kind of support is actually underlying this move from a fundamental on-chain perspective, and just really assessing some of those dynamics around profitability, some of the mining market recovery, and various indicators now that we've left the consolidation range that we've been in for about 2.5 months, 3 months. We can start to see now that prices are moving beyond that zone. On chain, we can assess particularly profitability to see what kind of accumulation we've essentially left behind us, what kind of support level now exists below us. So what we'll cover in today's discussion is we'll start with an overview of the mining market, and we'll particularly look at the slow recovery of hash rate, and then just some of the dynamics around miner revenue and how that actually changes and the interplay between hash rate and overall market revenue. We'll look at the new all-time high that was just printed for the realized cap and what this tells us about overall capital inflows into the Bitcoin network. We'll look at some of the exchange flows, the inflows and the outflows as an indication of accumulation and really trying to assess that balance between distribution and accumulation. And then we'll look at the profitability. So now that prices have moved beyond our previous trading range, we can assess how many coins have now returned into the green, how many are now profitable, and how much net unrealized profit and loss remains in the system. And we can look at this across different cohorts. So let's jump into the week on chain dashboard and we'll get started with our analysis. So here we are in Glassnode Studio. We're looking at our week on chain 33 dashboard. And we can see that we've had a fairly strong rally across the entire market this week, and it's continuing a number of weeks of positive price action. So Bitcoin rallied from about 43,000 to just shy of 48,000 last week, and it really is showing that strength as we rally out of that previous accumulation range, which we were in for about 2.5 months, since about mid-May right the way through to August, and we've finally started to see some lift off the bottom. So in previous newsletters, what we've looked at is what was the accumulation going on when we were inside that range. And it can be a little bit harder to assess at that point in time. It's much easier when we see that price moves away from that range. We can start looking at the profitability of coins that were otherwise accumulated within the previous zone. So we get a bit more of a view now that price has got some distance between the accumulation range. And we can also start looking at overall what kind of support underlies this move. Is there a fundamental basis in the on-chain space that really supports this rally? Is there any signs of weakness? What we're really looking at is what kind of strength is there that's really supporting this rally, and does that make it a more sustainable view in our eyes? So we're going to start our analysis by looking at the mining market. So we can see here in our mean hash rate that there's just been a substantial drop since the peak, which is around 180 exahash. Which is really driven by the great migration as miners move their machines out of China, and many of them remain offline. Now, when a miner is offline, they still have all of the costs, the capex that they've put into buying their hardware. There's still going to be debt and financing and many layers to it. And when they're not earning an income, it necessitates some form of sell pressure. They need to liquidate parts of their BTC treasuries in order to fund some of those logistical costs because they just don't have an income. Now, what we've seen is after this 50% correction, which gives us an idea of the magnitude of miners that were affected, roughly half the network, we've started to see about a 25% rally off that bottom. So it's showing that some of those miners are actually coming back in. If we think about 25% of the 50% who are affected, that's a 12.5% of the network that's now come back online. Now, some portion of that may be the offline miners in China who are finding new locations, new hosting locations for their hardware. It could be previously obsolete hardware that now finds itself profitability, is being switched on elsewhere in the world. There's many dynamics at play, but ultimately what we're seeing is a recovery in the hash rate market, which is showing that there's that resilience in the system, right? The network is a self-correcting beast. And we can actually see in our miner net position change that we've got an increase in overall accumulation by miners. They are on balance accumulating more coins than they're selling. So their overall net treasuries are in fact growing. Now, bear in mind that the total miner revenue, so this is regulated by the difficulty adjustment. We can see here the halving back in May 2020. So it really regulates itself around previously about 1,800 on average per day coins mined. It's then declined down to approximately 900 per day mined. We can see that as hash rate dropped off a cliff, we also got a reduction, a temporary reduction in issuance. And this was simply because prior to the difficulty adjusting to this new change in the hash rate market, blocks started coming in slower. So when there's fewer blocks being mined each day, there's less revenue coming in. Now, since the difficulty adjustment has come in and corrected and found that new equilibrium, we've seen our overall net issuance in BTC return back into this approximate 900 per day range. And as a result of our hash rate starting to recover, we can actually see that our hash ribbon, which is one of these metrics that it plots a faster moving average, the 30-day and the 60-day moving average. And when the hash rate drops quite significantly or rises quite significantly very quickly, the 60-day will essentially move much, much slower than the 30-day, and the 30-day will cut above in a bullish push, or cut to the downside, which will show that there's a capitulation style event. So these capitulations or income stress in the mining market are highlighted when the 30-day tracks below the 60-day. You can see it's generally during periods of downwards price action. We saw that there was one during the actual halving event when miner revenue was sliced in half. There was the March 2020 event, which halved the price. So it was almost a double halving back to back. And then we've seen a fairly substantial zone of this during the Great Migration. So really this is representing stress in the mining market. There's some portion of the miners who are currently earning no income. And as a result, there could be additional sell pressure as they sell their treasuries rather than essentially to cover the costs that they're incurring at that point in time. So as we get this recovery in hash rate, that means that the 30-day moving average has now sliced back above the 60-day. It means that in generally speaking, the worst is over when it comes to the overall stress in the market. Now, again, something else could change, but at the moment, this is showing that we're getting that upwards momentum and a recovery overall in the mining market. Now, just before we carry on, I want to duck across to our workbench tool to just show how we developed the overall revenue per hash, which is an interesting model, and we can just talk about some of the dynamics and show off how this tool actually works. So Workbench is a new feature that we've recently released, and what it allows us to do is to include multiple metrics and then create our own formulation, so we can actually look at the interplay and the interrelation between various metrics. So what we've got plotted here is our price in black, just to show us whereabouts we are in the market cycle. We've got here our hash rate. So we've established a 14-day moving median, which just really smooths out across the difficulty adjustment what is the typical hash rate that's going on. So you can see it's a much, much smoother signal than our standard hash rate. And what we can see is this continuous overall growth. We can see our two capitulation events, one after March 2020, and then one at the halving, where we saw a significant decline in hash rate when some of those miners saw their income halve and then halve again. Now we've seen a continuous, on a macro scale, uptrend in hash rate, all the way until the Great Migration really set in. And following this point, we can see this precipitous drop where we went from about 180 exahash all the way down to 90. So it's about a 50% drawdown. And now we've since recovered by about 25%. Now we can also overlay our miner revenue in BTC, and we've got the same 14-day moving median applied. And we can see up here that we're tracking about our 1,800 coins per day. Following our halving event, that then drops down to a relatively stable 900 per day. So you can see that hash rate is increasing, even though the overall revenue in BTC remains fairly constant. As we see our decline in hash rate, the revenue also drops. This is because of those slower blocks. There's just simply less coins being issued per day. And now that we have a recovery in hash rate, we see that our revenue returns back up into this 900 coin per day range. So now the question is, within all this dynamic market where we've got increasing hash rate, we've got a relatively stable issuance. This is what the difficulty adjustment does. It keeps the coin issuance constant or relatively constant over a long period of time. So we have a deterministic supply schedule. What we can do is actually remove our hash rate and our miner revenue, and we can create a new metric using our formula tool, which is where we've taken M3, which is our miner revenue in BTC, divided by our hash rate, M2, and then we've multiplied by this factor 1E18, which presents it in a reasonable number. So we're looking at exahash, which is a very, very large number. What we're showing here is how much BTC is mined per exahash. So if you look at all of the machines that a particular miner has, they can perform their calculations, work out what kind of hash rate their equipment can provide, and they can use that to actually formulate how many coins they expect to earn given their share of the hash rate network. And what we can see here is this continued decline. So this is pre-halving. We have a declining income, so revenue in BTC, declining revenue per hash. This is showing that we have a constant amount of coins being issued, but increasing hash rate, increasing competition over the same number of coins. We then have a halving event, and then that hash rate trend largely continues. So we're seeing increasing competition, more machines fighting over that same 900 coins. We get to the very, very bottom here in March when we get the block slowdown, the smallest number of coins are being issued. And now what we see is that as the difficulty adjustment brings the protocol back into equilibrium, you have less miners, but they're still mining that same 900 coins per day. And we actually see miner revenue has now spiked. So we're up here around 9.2 to around 8.9 BTC, which you can actually see on a relative scale is back where we were before all of that hash rate. Let's bring our hash rate chart back on. Before all of this extra hash rate has come back online, the competition is back down here, which is where we were in July 2020. And we can see that our revenue per exahash is also back where it was in May, July 2020. So we've essentially undone all of the competition. So because that 50% or slightly less, 35% of the overall competition in the mining market is currently not on the network, the miners who remain active are actually earning far more BTC for the same amount of hashing power. So what this is actually leading to overall is it's enabling our miners, the miners who remain online, to actually stack more BTC. They're able to accumulate a larger proportion of their income because for the same cost, they're earning more coin. So this is how the mining market self-equalizes itself, and why the difficulty adjustment is such a unique and interesting part of the Bitcoin protocol, is it keeps everything in balance even after seeing a 50% drawdown in hash rate. It makes sure that the incentives are aligned to bring more miners in to earn that same deterministic issuance, and it's this self-equalizing system. So that's just a bit of an insight into what's going on in the mining market, that even though we have some miners offline, those who are still online are actually able to earn more revenue per hash, which is overall a self-equalizing system. So now we'll come across to the realized cap. Now the realized cap in the top left here is kind of the on-chain equivalent to the market cap. Now, where the market cap looks at all of the coins that are in circulating supply, and it multiplies it by the current spot price. What the realized price does is it looks at every coin and when it was last spent on chain. So if a coin was last moved at $6,000, it will be valued at that price. So what it's really capturing is what is the value of every coin at the time when it last moved. And this is really one of the core pieces or components of the overall on-chain space. We use this in many of our metrics as an underlying concept. So the way to consider the realized cap or the realized price is it's a measure of how much has been invested, how much value is stored in Bitcoin, how much value is actually been, or the capital inflows into the network. And what we've seen is actually hit an all-time high this week. We've seen an all-time high in the realized cap, over $380 billion. And what we will see with the realized cap is that as coins that were purchased cheaper are spent on chain, they're sold, every seller has a buyer, and that's why we represent capital inflows as the realized cap. So when we have these uptrends in realized cap, it's showing that older coins that were purchased cheaper are being spent. Somebody is stepping in and buying those coins, representing a new capital inflow. When we have downtrends that we saw recently, it shows that coins are being sold at a loss. And we can see this in our net realized profits and loss. This same downtrend in the realized cap is what we saw all the way through May through to July, where we saw two capitulation events, and the majority of coins that were being spent on chain were those accumulated up here in this $50,000, $60,000 range. So they're being spent on chain at a loss, they're realizing a net loss. And since that point, since our breakout following the $29,000 sell-off, so right through August, we've seen people realizing profits again, and the market's continued higher, which is demonstrating that it's able to actually absorb that capital inflow. So this is what we're seeing overall. It's a positive sign that we're seeing our realized cap hitting all-time highs. It's showing that people are realizing profits on their coins, the market is absorbing it, and price is continuing to rally higher. So it's showing that strength and underlying movement higher in the market. And we can actually see this when we look at our mean. This is the average volume. So how large is a transaction in dollar size that's flowing to exchanges versus from exchanges. So what we're seeing is what is the aggregate size of coins flowing in versus flowing out. What we can see here is that in terms of volume that's flowing into the exchange, we're currently sitting around $24,000. So that means that the average transaction is about $24,000 worth of BTC flowing into the exchange. And if we compare that to our recent values of value flowing out, it's between $35,000 and $32,000. So $24,000 going in and $30,000 to $32,000 coming out. So what we're seeing is that there's actually more volume or larger transactions flowing out of exchanges than in. The average size is much larger coming out than is going in. And we can actually see this in our exchange net position change. We can see that overall, particularly during this rally, there's been some fairly substantial exchange outflows. And what this is really demonstrating is that there is a net accumulation that's going on. Now, remember, some of these coins may well have been accumulated previously and they were actually waiting for price strength before they withdrew. They were sitting there waiting for the volatility to resolve. So it's possible that some of those coins were actually accumulated over the course of the last couple of months, and only now they're being withdrawn. But nevertheless, it is showing that market strength. It's showing that there's a desire to withdraw coins, take them into self-custody, and coins are on net leaving exchanges. Now, if we look at our percent supply and profit, we mentioned at the start of this that overall, when price moves away from a large consolidation range, like what we've just had over the last couple of months, what we can see is how many coins that were moved on chain have now moved back into the green. What is the amount of coin that is now in profit that was previously sometimes at a profit, sometimes at a loss? Price was kind of fluctuating around in that trading range. And this is what we can see in this zone. This is this fluctuation. Let's zoom in a little bit. Now, since price has rallied, we can see that the rise in percent supply and profit, so how much of the circulating supply is now in profit relative to its on-chain price, we can see that this has risen quite dramatically. Now, note here that we were trading in this between $30,000 and $40,000 price range for about 2.5 months. Now, we also traded in this range back here in January 2021. And you can see here on our axis that we were roughly between 90%, and as we rallied onwards to all-time highs, it moved up to 100%. So we can estimate from that that at least 10% of the supply had some cost basis in this range. Now, what we've seen in this zone is that obviously the percent supply and profit has fallen as more people bought up here, sold their coins. So we saw this gradual decline in percent supply and profit. Since we've bounced from the bottom, this is actually about 19.2% of the total supply. Now, remember that this in the same price range, this was 10%, this is 19.2%. So what that's actually showing is that about 9.2% or about 1.4 million coins additionally have been accumulated in this range. It's showing us how many coins have a cost basis that were accumulated and last purchased within this price range. So it's almost double the amount of coins that were previously purchased here have been reaccumulated back here. So it's showing us how much accumulation has actually gone on in this previous range by looking at the percent supply and profit. So somewhere in the order of about 1.4 million additional coins representing 19.2% of the supply. So it does indicate that there's a very, very large amount of accumulation that's occurred within this $30,000 to $40,000 price range. And finally, just to close out, so we've talked about the realized cap as the aggregate cost basis for the market. Now, as price moves around or the market cap moves around, we can look at what the current price is versus what the on-chain cost basis is. And what that gives us an indication of is how many paper gains or paper losses remain in the system. And this is what we distill down into these cyclical oscillators called net unrealized profit and loss, or NUPL. Now, we have two different versions of this metric here. On the left-hand side is the entire market. So this is all coins included. And on the right-hand side, we have what's called the short-term holder NUPL. And this is really shrinking down who we're looking at, the cohort of people only to coins younger than 5 months old, about 155 days. So we can see what's going on in terms of the overall profitability for these different cohorts. So if we start with the total market, what we've seen is that we've now bounced from this relatively low zone. So we've had this significant pullback. The numbers on the left-hand side here, so this is 0.5. This is the level that we've just broken above into the green. That means that on the whole, 50% of Bitcoin's market cap is available as paper gains to be realized. Now, what happens as we rally higher up towards this 0.75 level? This is saying that 75% of the market cap worth of value is in paper gains. It creates an incentive for people to sell, because when people are in profit, generally there's going to be some profits that get taken off the table. The incentive to sell gets stronger the higher the price goes. So as coins then get sold, it naturally creates a cycle top and we start to actually pull back. It creates overhead resistance and the market then has to reaccumulate that supply. So we can see here that we've actually bounced back up into the relative profit zone. We haven't hit this 0.75 level, but it's certainly showing that there's a strength. The markets continue to trend higher, but at the same time, the incentive to sell is starting to creep higher. Now, in both of these metrics, for short-term holders, they've actually just broken above a value of 0. So previously, short-term holders on the whole were at a loss. They were actually holding coins that were overall significantly underwater, down somewhere around negative 0.5. So almost a 50% loss for many of those participants. So this metric is now broken back above water. And if you think about this from a psychological perspective, many people who've recently purchased, they may have actually been quite scared by the sell-off, the 50% sell-off in May. And as price gets back to their cost basis where they previously bought in, that could very well be an incentive to say, you know what, I'm actually going to leave this market. That was enough volatility for me. I'm going to walk away. So there's a psychological layer to this. Now, of all of the things that we've looked at here, it's showing that there's still a lot of strength in the market and quite clearly a lot of accumulation has occurred below this zone. Both of these metrics, however, there's only two real instances where they perform this, where the short-term holder NUPL breaks above 0 and the overall market breaks above 0.5. There's two real instances that this happens. In a bear market, when you essentially get a major sell-off, a correction back to the upside, and everyone goes, you know what, I'm going to take this exit liquidity and leave. Or during the disbelief rally of a bull market. So as everybody thinks that it's going to roll over into a bear and price continues to power through it. They're really the two instances where this happens. And it really does say that it's likely there could be some volatility. It's likely that traders and investors are going to test each other. The bulls and bears are going to test each other as some people take profits. Other people believe that the thing's going to keep rallying into a bull. Some people believe it's a bear market. So ultimately, the market's getting to a decision point as to where we go from here. As short-term holders return to their cost basis, the overall market has some kind of profit back in after seeing a fairly scary drop. And really, the next couple of months is going to tell us a lot about what goes on from here. So I'm certainly keeping an eye on these particular oscillators just to really see how they play out, and particularly comparing to previous fractals. So as always, thank you for tuning in. I hope you're enjoying these videos. Be sure to give us a subscribe and a like and share these videos on your socials. And I certainly look forward to seeing you next week. Cheers.